Good afternoon, ladies and gentlemen. Welcome back to the 28th of July weekly market review. It's coming to the end of July, and this is usually the busiest time of the earnings season. So, as usual, I have with me Gerald today. How are you, Gerald?
Hi, Sunny. Hi, everyone who has joined today's weekly market review. So, as Sunny mentioned, we are in a very busy period for global financial markets. Many companies are reporting their first half earnings. At the same time, we are watching the developments on the global trade front very closely. So, that's keeping all of us very busy having updates on some of these market developments.
Yes, so we are all tracking developments on many fronts. On the trade fronts, we are looking at last week we see US trade deal with Japan and Indonesia. And over the weekend, we saw that there's also a trade deal with EU, the largest trading bloc. And this week, we are looking at China and US coming to a deal, somewhat of a deal or extension to the deal that we are seeing right now. So things are developing positively in the tariff negotiation. And on the earnings side, last week we saw Google and Alphabet and Tesla earnings came out, which Alphabet performed well. And also on the Singapore side, we see some of the REITs also having their results, which Gerald will take us through. So I'll let Gerald take over and go through some of the fantastic REITs earnings that we see so far.
Sure. So, the usual disclaimers before we start that today's sharing is for information purposes only and does not represent financial advice. If you find the weekly market review helpful, do leave us a review on Google. And if you'd like to join SIAS as a member, you can go to the website sias.org.sg/membership or scan the QR code. And as a SIAS member, you can access various online resources as well as investor education programs. Okay, so what did we see for the market in the past week? The US S&P 500 and the Nasdaq reached all-time high. The S&P 500 is now close to the 6,400 levels. And the STI also saw strong gains in the past week, up 1.7% to 4,261 points. Okay, I wanted to focus a bit more on the Singapore market because it has actually outperformed the S&P 500 in the past week. And as we can see from this chart here, it has effectively rebounded very strongly from the April lows of about 3,400 points to now 4,261 points. So part of it is driven by the easing of the trade tensions. Like Sunny mentioned, we are seeing some of the deals actually coming through, but in the meantime, the global uncertainty remains high, which is why investors are looking at safe haven markets such as the Singapore market. But in the past week, we also saw the MAS announcing measures to revitalize the Singapore market. So if I were to look at some of the measures that have been announced so far, they mainly revolve around three pillars: supply, demand, as well as connectivity slash trading. On the supply side, it is really around the way that we are looking to improve the attractiveness to quality listings. And then on the demand side, to increase investor interest. And then on the connectivity side, ways that we can actually develop some of these cross-border partnerships. So I think what came out last week were really the progress made on the demand side, where we saw measures around the 5 billion Equity Market Development Program, or otherwise known as the EQDP, to strengthen the local fund management ecosystem. So what we heard there is that there has been an announcement of 1.1 billion being deployed to three fund managers, which have been selected as part of this EQDP program. And these fund managers will make use of these funds to be able to invest in the Singapore stock market. So that was the key announcement in the past week. And that has also helped to drive interest towards some of the mid-cap companies in the Singapore market. As the EQDP is being deployed, I think the expectation is that that will help to stimulate interest towards some of these names in the Singapore market. In the announcement last week, we also see measures being announced to enhance the local research ecosystem through expanded grants, as well as ways to strengthen investor confidence, including ways to enhance investor recourse avenues. Okay, so I think this is also one of the reasons why the Singapore market has continued to do well, given the measures that have been announced to revitalize the Singapore market. Okay, so in the past week, we saw the top performers, DFI Retail Group up 13%, City Developments up 8.1%. The strength in DFI is really driven by the strong earnings that were announced, as well as the additional dividend that was being announced as well. So that actually drove the stock up by 13%. For city developments, we shared in last week's weekly market review around some of the improvement in sentiment towards the property market as interest rates start to come down. Okay, so outside of that, we also have Yangtze Shipbuilding, ST Engineering, as well as Jardine Matheson. And for ST Engineering, it is really driven by the very strong order book that they announced in the third quarter of this year. Okay, in terms of the worst performers, we have some names that we see some profit taking in, including Singtel, Semcom Industries, as well as Hong Kong Land. Okay, like Sunny mentioned earlier, we are going into the earnings season in Singapore. So we have some of the REITs that started reporting. We start with Keppel DC REIT, which actually reported a fairly strong growth in the distribution per unit. And that is bringing the share price of Keppel DC REIT up to its 52-week high. Okay, so just as a recap of Keppel DC REIT, since we have been talking quite a bit about data center REITs, it is a pure play data center REIT with assets that are worth close to 5 billion Sing dollars, and that spans 24 data centers across 10 countries. The bulk of its assets are in Asia Pacific, where the Singapore assets represent 66% of its portfolio. Okay, so what we see here is that the gross revenue was up by 34%, and the net property income was up by 38%. That was driven partly by the acquisitions that were completed in the fourth quarter of last year, which actually helped to boost the distributions of Keppel DC REIT. What's also interesting to me here is that the finance cost has started to come down by 5.3% from 25.9 million in the first half of 2024 to 24.5 million in the first half of 2025. So as we can see with the lower interest rates, that's helping some of the REITs in terms of lowering their finance costs. So overall, we see that with the increase in net property income, with the fall in the finance cost, the distributable income actually rose by 57% to 127 million. Overall, we see that the distribution per unit rose by 12.8% to 5.133 cents. So that is one of the few REITs that we see fairly strong growth in the distribution per unit. The other thing to highlight about Keppel DC REIT is that the fundamentals of the REIT remains fairly strong. We see here that the first half 2025 portfolio revision was at 51%. So that's also one of the factors that's helped to boost the net property income on top of the acquisitions that were completed. Okay, what is driving this very strong growth in the rental reversions? We still see that the structural growth in the data center market is there, and part of it is driven by demand for some of these AI users that is helping to drive the demand for data center. We also see that a lot of the growth is in the Asia Pacific market, which is where Keppel DC REIT is actually being positioned. And in Europe, there is also demand that is coming through from some of the hyperscales, which are some of the cloud providers like AWS. So that is helping to boost the overall demand for data center assets. If you were to look at the balance sheet of Keppel DC REIT, the aggregate leverage remains low at 30%. So that has actually declined from 31st of March. And like I mentioned earlier, the average cost of debt has actually come down to 3%. So that is helping to bring down the financing cost of Keppel DC REIT. Okay, if I was to look at the valuation of Keppel DC REIT now, about 1.52 times price to book, which is above the historical average. And if I were to look at the dividend yield, that is slightly above 4%, which is below the historical average. Okay, next I'll look at Mapletree Logistics Trust, which is another industrial REIT that reported their earnings in the past week. But in contrast to Keppel DC REIT, we see that the share price of Mapletree Logistics Trust remains fairly depressed and has not fully recovered from the April sell down. Okay, so what we see here for Mapletree Logistics Trust is that for the first quarter earnings, which is the 3 months ending 30th June, the gross revenue and net property income actually declined. So that is a contrast to what we see for Keppel DC REIT. In terms of the borrowing cost, that has actually continued to go up to now about 39.3 million compared to 38.4 million in the first quarter of last year. So what this means is that the amount that is available for distribution to unit holders has actually declined by about 11% compared to the previous year. And overall, what we see for the distribution per unit is that it is 1.812 cents, which is a 12% decline compared to the previous year. Okay, so what we see is that compared to Keppel DC REIT, which saw an increase in the distribution per unit, for Mapletree Logistics Trust, the net property income came down, the borrowing cost increased, and all of that led to the decline in the distribution per unit. If you're to look at the operational performance, we see here that the occupancy rate actually came down in Singapore to about 93.9%. That is partly due to the Mapletree Joo Koon Logistics Hub, which was completed in May 2025, and with an occupancy rate of just 42.4% as of June 2025. Okay, excluding this particular asset, the Singapore occupancy rate would have gone up by 0.5 percentage points to 96.4%. The portfolio occupancy was dragged by this asset as a result, coming down to 95.7%. And what the REIT manager noted is that excluding this asset, the portfolio occupancy would be up slightly at 96.3%. If we're to look at the rental reversions, the portfolio rental reversions was at 2.1%. So that represents a slight slowdown from what we saw in the fourth quarter of fiscal year 24-25, which was at 5.1%. Okay, what we see here is that excluding China, the portfolio reversions would be slightly higher at 2.8%, because China continues to see negative rental reversions of 7.5%. Okay, earlier I mentioned this asset enhancement at the asset at Joo Koon. So the estimated development cost of the AEI was at 205 million. And the completion was actually in May 2025, where they achieved their TOP. So with that, the current committed occupancy is at 60%. And what the REIT manager noted is that there's another 25% of the space that's under active negotiations. So this is one of the assets that Mapletree Logistics Trust is performing asset enhancement on, with the hope that that will actually help to unlock value for the REIT. If you were to look at the gearing of Mapletree Logistics Trust, that has gone up to 41.2% from 40.7% as of 31st March 2025. And what we see here is that the weighted average interest rate is at 2.7%, which is unchanged from where it was as at 31st March 2025. So currently, the price to book valuation of Mapletree Logistics Trust is at 0.9 times price to book, which is below the sector average. And what we see here is that the dividend yield is above 6%, which is above the historical average. So I mentioned earlier that it is a busy week. We have got a lot of companies that are reporting this week, particularly the REITs. Also have the US earnings season, including Apple and Amazon, that would be reporting their earnings this week. And we also have the Federal Reserve interest rate decision coming up this week. Okay, so we'll continue to keep a lookout for this earnings and update everyone through the weekly market review. With that, I'll hand over to Sunny for the technical analysis.
Okay, thanks, Gerald, for the updates on some of the REITs earning that we see last week. So before I go to the technical analysis, I just want to point out one headline that we saw last Friday, and that was JP Morgan raising the STI target with a base case of 4,500 points and a bull case of about 5,000 target. So they are also saying that they upgrade the real estate sector as well. So these are some of the keynotes that you should be looking out for the second half on the STI developments. I'll leave you to read on that report. You can just Google that news, JP Morgan STI target. Okay, so this is the STI index. As Gerald pointed out, that the STI index is actually the outperformer among global indices this year. We are up almost 12% year to date, compared with the US index year to date gain of about 5 to 8%. Of course, the Singapore market is the beneficiary of the trade tariffs negotiation, the uncertainty, Singapore being the safe haven with companies giving very strong dividend yield. Attracting a lot of investors' interest. So going into the earnings season so far, the Singapore earnings season so far, we have seen that the earnings reports has been pretty positive, and all that has been baked into the STI index performance right now. And today or last Friday, we see some kind of a pullback on the STI index. This Monday morning, we can see that the STI index is down about 16 points or 0.4%. So we are still waiting. There could be still more catalysts coming up because we are still in the middle of the earnings season. We have a lot of REITs that are going to report earnings this week. And of course, we also have the bank's earnings starting this Friday with OCBC and DBS next week as well. So these are some of the key results that could push the STI higher. But if you ask me where are the key near-term resistance level to look out for, with the STI now at the all-time high already. The most recent high was on the 24th of July at 4,274 points. The next resistance level that I see will be the 4,300 psychological level, as well as the upper bound of that Bollinger Band. That would be the near-term peak for the next few weeks on the STI index. Given that we have seen today's pullback, and of course the negative close on Friday of the STI, we see that most of the expectation of the earnings season could already be baked in. And you can look at the MACD indicator, which is also showing the convergence of the MACD towards the signal line. That could mean that the STI may have peaked in the near term, and it's on the lookout for the next catalyst to push it up to the next level. So 4,003 will be the near-term resistance level. Support level that will come in first will be the 20 days moving average, and that would be the 4,123 points, with the 50 days moving average now at the 3,995 points, or what we call the 4,000 handle. Okay, so 4,001, 4,000 handle would be the key support level for the STI index. If it pulls back to this level, definitely it will attract a lot of technical traders to come back in to get into the STI index as well. On the RSI, you can see that the latest reading now at 81 is way above the 70-point mark overbought level. It has been at above the 70-point level at least for the past 2 weeks already. So we can see that it is starting to come down. That means that the uptrend momentum that we have been observing in the past 2 to 3 weeks is already subsiding right now, and STI will go into a consolidation mode, with the first support at 4,100 20 days moving average, and the next at the 4,000 handle. So 4,000 to 4,003 will be the range that we are looking at the STI moving in the next couple of weeks. Next, let me move to the US indices. Okay, all the US indices performed well last week because the earnings season so far has been pretty strong. Most of the company that has reported managed to beat the analyst expectation, as well as some of the companies are able to give some positive forward guidance, because the trade tariff seems to be the tension in the trade tariff seems to be subsiding, and hence they are more positive on the outlook. So on the Dow Jones Index, which is up about 5.2% year to date, you can see that we are still somewhat a little bit away from the previous all-time high that we observed, which is in the December period, and that is at the high of 45,073 points. So we are about 173 points away from that level for the Dow Jones Index. Looking at where the index is moving right now, it is still holding on tightly to the 20 days moving average as the pivot or the most closest support level at 44,400. The upper bound resistance level, of course, will be an all-time high 45,000 handle that we are looking at, which also coincides with the upper bound of that Bollinger Band. Support side, the lower bound of the Bollinger Band comes in at 43,878 points, with the 50 days moving average close by at 43,254 points. Indicator-wise, I think it's slightly neutral, okay, with the MACD slightly negative. Here you can see that the MACD has been trending just below the signal line for the past couple of weeks, 2 weeks, and that means that we could be the index, the Dow Jones Index will be looking for the next catalyst to push up the next leg higher. But if you're looking for a technical support, that means the low bound of the Bollinger Band at 43,878 points will be your first reference for support. On the RSI, the reading at 63 now has came down from the peak that we saw at the start of July, which is the start of the earnings season. So now at 63, it is showing that momentum is still healthy, and it is poised to sort of continue to trend at the current level or hold the current level to wait for the next catalyst to push it up higher. Okay, so for Dow Jones Index, the resistance to watch will be the 45,000 handle, which is very close by, just 100 points away. And then after that, if you're looking for a pullback and support level to get back in, the low bound of the Bollinger Band at 43,800 and the 50 days moving average at 43,200 will be key levels to watch out for to get back on the Dow Jones Index. Next, let us move to the broad index, the S&P 500, which has been clocking all-time high the whole of last week. Every time we look at the daily headlines, we see that S&P managed to close at an all-time high. The high now stands at 6,395 points. So that is the reference that we are looking at. Can it push higher? This is the all-time high. We don't have sort of a technical level to watch at the top, but we can see that at least for the support side, the lower bound of the Bollinger Band at 6,162 is coinciding with the high that we saw in the early part of this year, the February and January period. So if the S&P 500 comes back down to this level, this previous resistance level that we see may have a change in polarity and support the S&P 500 further. And with the 50 days moving average catching up to the 6,100 level as well, I think this could be a very good level to get back on the S&P 500 should we see a technical pullback. On the indicator side, MACD indicator is says neutral to slight negative. We can see that the MACD line and the signal line is intertwining with each other, thereby telling us that hey, there is no MACD indicator is not giving us any direction of where the S&P 500 is heading, while the RSI has just breached the 70-point mark, which is the overbought level, now at 76. So investors need to be very careful when getting into the US indices, especially the S&P 500 right now. And I would say that it will be good to seek some safety on the 20 days or the low bound of the Bollinger Band to get some support level before sort of chasing where the S&P 500 is at right now. Lastly, let's move to the tech-heavy Nasdaq Composite Index. So this is the index was of course pushed up by the Alphabet earnings, which was very positive. And this week we are looking at another 4 of the Magnificent 7 reporting their results: Meta, Microsoft, Apple, and Amazon. So a very high chance that we could see the Nasdaq push higher given this Magnificent 7 counters earnings results this week. So the upper bound, we can see that the high is now at 21,159 points. Upper bound of the Bollinger Band at 21,197. So 22,000, I think, likely would not be a problem for the Nasdaq Composite Index towards the end of the year. But near term, we are looking at 21,200 points as the near term resistance level. Support level wise, we have the 20 days moving average at 20,669 points, with the low bound on the Bollinger Band at 20,140 points. Close by is the 19,950 days moving average. So the MACD indicator is a neutral right now, I would say, because it's not showing any kind of trajectory or direction that we are going in. So it's a neutral on the Nasdaq Composite Index. The RSI has reached above the 70-point overbought level. So that could mean that investors, again, would be very cautious when buying into some of the mega tech stocks going into the earnings season. So a lot of the upside has already been baked into the tech stocks results. So the earnings results needs to meet or exceed expectation for them to sustain at the current level. Okay. So these are the key things that we are looking at this week. So anything else to add, Gerald?
Yes, so apart from the earnings, we also have the Federal Reserve meeting that's coming up this week. So that's something I'll be keeping a very close lookout for to get us some indication about whether the Fed will go ahead with the interest rate cuts in the second half of this year.
Yes, and on the Singapore side, we also have the MAS, MPS, the monetary policy statement as well this week. So it's going to be a very busy week and eventful week. But going into this busy week, we are seeing a lot of positive momentum over here. So that's a good sign. So I think for now, I think we will leave you with this information. So in the meantime, do trade safe and stay safe. And we will see you again in the 4th of August with a market review. Goodbye.
See you.
See you.